Bitcoin has multiple long-term and short-term variables that affect its price, and many folks debate what its major correlations are, if any. It turns out, the same factors that affect Bitcoin's price, real rates of inflation, monetary and fiscal policy, and market exuberance, also partially determine to which assets Bitcoin is correlated. Over the long run since its launch, increasing user adoption, ever-strengthening security, and the widening network effect have propelled Bitcoin's market capitalization to greater and greater heights. Those are the long-term variables. Lyn Alden is the founder of Lyn Alden Investment Strategy. Subscribe to First Mover, our daily newsletter about markets. Subscribe by signing up. You will receive emails about CoinDesk products and you agree to our terms and conditions and privacy policy. The halving periods tend to act as fundamental catalysts for the next bull market within this long-term trend, as new supply gets cut in half while incoming demand remains robust. As long as the demand indeed remains strong, upward pressure builds on its price, and then when it eventually breaks up, momentum traders hop on board with a new influx of demand and drive it up further. All pre-programmed halving events occurred during periods where Bitcoin had been off from its all-time highs for at least a year, and usually more than 1 year. On the other hand, the year after a halving has always been great for its price, without exception so far, albeit with a very small sample size, and has eventually led to the next blow-off top in a period of consolidation. See also, Noel Acheson, Crypto Long and Short, How Bitcoin Correlations Drive the Narrative Visualizing Post-Halving Market Reactions. Blockchain, calm. During those long consolidations, Bitcoin becomes more correlated to short-term variables related to global liquidity and other risk assets. This becomes especially true as it reaches wider adoption and is invested in by the financial community. Basically, the ongoing debates about the degree to which Bitcoin is correlated to other assets would do well to break Bitcoin's price behavior into two phases: bull runs and consolidation periods. If we look at percent drawdowns in Bitcoin compared to drawdowns in the S&P 500, for example, we can see a lot of correlation over the past 2 years in this consolidation phase, particularly when sharp drawdowns occur and investors broadly de-risk their holdings. Percent drawdowns in Bitcoin compared to drawdowns in the S&P 500 shows correlation. iCarts, more interestingly, during Bitcoin's consolidation period, it acts a lot like digital gold. Gold investors have long since known that the single biggest variable for gold price movements has historically been real interest rates. Real interest rates measure the difference between a risk-free yield, like the 10-year Treasury rate, and the prevailing inflation rate or expected forward inflation rate. Whenever real rates go lower, especially if they turn negative, gold tends to spike in price. On the other hand, when real rates rise, gold usually suffers. The period from 1980 to 2000 was particularly bad for gold because real rates were strongly positive for the entire duration. This relationship is due to the opportunity cost of holding gold. Gold is a scarce but yieldless asset and has fees for minting, verifying, purchasing, transportation, and secure storage. When bank accounts and treasury bonds pay yield much higher than the prevailing inflation rate, your purchasing power can grow within the fiat system. On the other hand, when bank accounts and treasury bonds no longer keep up with inflation and are being debased, you can read full post on CryptoFans News, link available in text below.